The financial world just witnessed something extraordinary that most people still don't fully comprehend. What unfolded in the silver markets represents far more than just another trading day with impressive gains. This marks the beginning of a fundamental transformation in how we understand value, scarcity, and the relationship between paper promises and physical reality. Picture the scene as markets opened on this particular Monday morning. Silver prices surged to levels that shattered previous records, climbing above $84 in early trading before settling around $83. On the surface, a 4% single-session move might seem impressive, but not unprecedented. However, focusing solely on Western trading venues misses the most revealing detail emerging from global markets. While traders in New York analyzed charts and debated resistance levels, something remarkable happened across the Pacific Ocean. The Shanghai Gold Exchange established their silver price at over $91 per ounce. Think about what that number actually means. A $7 gap exists between what buyers pay in Asia versus what sellers accept in the West. This isn't some temporary pricing inefficiency that arbitrage traders will quickly eliminate. When physical buyers consistently pay substantially more than paper contract prices suggest metal should cost, markets are screaming an uncomfortable truth. The system built on leverage and digital promises cannot satisfy actual demand for tangible metal. Physics eventually overrides algorithms. Real metal carries weight, occupies space, and exists in finite quantities. Digital contracts can multiply infinitely with keystrokes. The tension between these two realities has reached a breaking point. Consider what happened during the morning session. Prices opened just above $80, dipped briefly below that level, then suddenly rocketed upward in a nearly vertical move. This pattern mirrors what occurred in nickel markets during early 2022, when a major commercial entity found themselves catastrophically positioned during a geopolitical crisis. Vertical price movements like this signal forced liquidation. Somewhere within the financial system's complex machinery, an entity holding massive short positions ran out of room to maneuver. Their risk management systems likely triggered automatic buying regardless of price, creating that dramatic spike. These aren't voluntary transactions reflecting careful analysis. These are desperate emergency actions taken when survival becomes the only consideration. The chart shows a distinctive wick at the peak, where prices touched $84 before retreating. Traditional analysis might interpret this as rejection, suggesting the rally exhausted itself. That interpretation misses the deeper story. Those rapid reversals represent the final defensive stand from remaining short sellers who understand their precarious position. They recognize that sustained prices above certain thresholds, while Eastern markets trade much higher, means their positions become untenable. So they deploy everything available, selling contracts they may not actually possess, attempting to create the appearance of weakness that might trigger panic selling. Yet despite maximum effort and enormous selling volume, the daily candle closed positive and trends remained intact. Something fundamental changed over the weekend when markets were closed. News circulated, industrial users reassessed their supply chains, and pressure accumulated. When trading resumed, that built-up tension released immediately. Monday morning gaps through major resistance levels create specific psychological dynamics. Anyone sitting in cash waiting for hypothetical pullbacks suddenly confronts the possibility those opportunities might never materialize. Fear of missing significant moves drives subsequent price action as funds. Underperforming benchmarks feel compelled to chase momentum regardless of entry points. Now shift perspective from trading desks to corporate boardrooms where procurement officers face entirely different pressures. These individuals don't care about technical chart patterns or moving averages. Their singular focus involves ensuring manufacturing lines never stop. Major electronics manufacturers have committed billions toward new battery technologies that fundamentally require silver as a core component. Factories stand completed, equipment installed, contracts signed. But those contracts assumed available supply. They presumed vaults contained metal and exchanges could facilitate delivery. When Eastern markets began paying substantially more than Western venues, those assumptions evaporated instantly. Imagine managing silver procurement for a major battery manufacturer. You observe Eastern buyers paying $91 while Western markets quote $82. Basic logistics tells you every available ounce will flow toward higher prices, meaning metal departs Western warehouses heading east. If you don't act immediately and bid above current Western prices, your factories face material shortages. Empty factories mean missed production targets. Missed targets translate to surrendered market share and plummeting stock valuations. What choice exists? You panic buy. You contact mining operations directly, offering cash above exchange prices for immediate delivery, bypassing traditional channels entirely. This creates ghost supply that disappears from public view, while visible inventory mysteriously depletes. This phenomenon creates price inelasticity that confounds traditional economic analysis. Standard models assume rising prices reduce demand. That holds true for discretionary goods. If luxury items double in price, consumers purchase fewer. but silver functions as strategic industrial component, not luxury good. Consider the mathematics. Advanced battery packs might contain 50 grams of silver. At $60 per ounce, that represents roughly $100 of silver per vehicle. At $84 per ounce, approximately $135 per vehicle. Does a $35 material cost increase prevent anyone from purchasing a $50,000 electric vehicle? Obviously not. It represents a rounding error that manufacturers easily absorb or pass through to consumers. However, they absolutely cannot build vehicles without silver. Demand doesn't decrease at higher prices because availability matters infinitely more than cost. Fear of shortage outweighs paying a premium. This industrial panic establishes a floor beneath markets that paper manipulation cannot breach. Financial institutions can create unlimited short positions on futures exchanges attempting to suppress prices, but they cannot manufacture physical silver bars for desperate manufacturers. Samsung needs atoms. Tesla needs atoms. Solar manufacturers need atoms. Right now, atoms flow to highest bidders. Currently, Eastern exchanges paying over $90. We're witnessing silver's monetary premium becoming industrialized. For millennia, silver functioned as money. Then for roughly a century, markets treated it as mere industrial commodity. Now it serves both functions simultaneously. A monetary asset experiencing industrial supply squeeze creates unprecedented dynamics. We haven't even addressed military dimensions yet. Recent geopolitical developments increased tensions substantially. Modern warfare is fundamentally electronic. Every advanced weapon system, drone, satellite, and communications array requires silver because it's the most electrically conductive element available. The Department of Defense maintains no strategic silver stockpile, having sold reserves decades ago. If conflicts expand, military procurement becomes another inelastic buyer. Do you imagine defense departments care whether silver costs $84 or $184? They'll pay whatever secures materials for guidance systems and electronic warfare capabilities. You've got major manufacturers competing with military procurement, competing with central bank purchases, competing with speculators. Everyone chases the same shrinking physical pile. Meanwhile, commercial banks hold massive naked short positions through futures exchanges, praying prices decline before insolvency arrives. They're attempting to stop freight trains using paper barriers. Even assuming new supply emerges from mines, it must undergo refining. Raw ore must transform into fine industrial-grade bars, meeting manufacturer specifications. Refineries operate at maximum capacity. You cannot simply increase throughput. Processing requires time and energy. Reports suggest major refining operations are fully booked 6 months forward, running around-the-clock shifts, unable to process additional material. This means even at $200, a speed limit exists on new supply entering markets. The pipeline is completely saturated. When markets gap dramatically higher on Monday mornings, they're pricing in these bottlenecks. They're recognizing immediate metal carries substantially more value than future delivery promises. This is backwardation, where spot prices exceed futures prices, representing the ultimate physical shortage signal. Traders willingly pay premiums for immediate delivery rather than wait for future settlement because they don't trust future delivery will actually occur. Trust in just-in-time delivery systems has completely shattered. For 4 decades, global supply chains optimized for efficiency. Nobody maintained inventory. You ordered materials when needed. That era ended. We're entering just-in-case inventory management. Companies will begin hoarding and building stockpiles. Instead of maintaining 2-week supply buffers, manufacturers might hold 6-month reserves. If every major electronics producer decides tripling inventory buffers is prudent risk management, global demand doesn't increase 5%. It potentially doubles overnight. That's the demand shock currently unfolding, an inventory rebuilding cycle occurring simultaneously with currency crisis. When you observe volatile price action whipping between $84 and $82, don't get distracted by noise. Visualize the procurement officer sweating in Seoul. Picture the military logistics commander shouting at suppliers in Washington. See the Swiss refinery manager explaining 6-month waiting lists to desperate clients. That's actual reality. Charts merely display shadows of these real-world pressures. Financial institutions want everyone believing this represents speculative bubble. They want panic selling so they can cover short positions and ship metal to manufacturers. Don't provide their liquidity exit. Now the secret has escaped containment. The 10% move over recent sessions fired a flare into the night sky. Average individuals who haven't considered silver since 2011 suddenly notice rocket-like price action. We're witnessing the beginning stages of retail participation. Psychology shifts from questioning whether silver represents good investment toward urgently wondering how to acquire metal before supplies vanish. Leading indicators reveal this clearly. This narrative shift threatens short sellers because retail crowds demonstrate price insensitivity. Professional hedge fund managers calculate value. Retail investors buying during manias purchase momentum. They observe prices climbing from $80 to $84, and their psychology screams about missing opportunities. So they access brokerage accounts, visit local coin dealers, bringing capital waves that ignore resistance levels. But here's the critical problem. The retail distribution pipeline is tiny. Markets for coins, small bars, and rounds represent just the tip of a massive iceberg. The vast majority of silver exists in 1,000-ounce industrial bars, when major manufacturers vacuum up these large bars for battery production. No metal remains for private mints to transform into retail products. The feedstock for retail markets evaporates. Signs of physical breakdown at dealer levels are already visible. Major online bullion dealers display messages about delayed shipping, high-volume alerts, and most ominously, instructions to call for pricing. Why eliminate posted prices? Because volatility is so extreme that automated pricing software cannot maintain accuracy. If they sell coins at $85 and prices gap to $90 within 5 minutes, they lose money. So they freeze sales and turn off buy buttons. This creates unobtainium, where screen prices might show $83, but actually purchasing an ounce proves impossible. Dealers charge premiums of $15, $20, even $25 over quoted spot prices. This means real street prices for holding metal already crossed $100. The disconnect is complete. 2 separate markets now exist. Paper markets on futures exchanges, where banks trade digital contracts establishing fictitious prices, and physical markets on the street, where real metal trades at massive premiums because insufficient supply exists. This presents the most dangerous trap for new retail participants, the ETF trap. When public excitement builds around silver, most people don't purchase physical metal. It seems too complicated. Storage poses challenges. Shipping costs money. So they open stock trading applications and purchase ETFs, thinking they're helping squeeze efforts and buying silver. They're mistaken. Buying paper ETFs during physical shortages resembles purchasing tickets for concerts at venues that already burned down. You hold the ticket, but no show exists. Authorized participants managing these ETFs are often the same bullion banks holding short positions. When billions pour into ETFs, you're essentially handing cash to entities fighting against your interests. Central banks understand this truth. That's why they purchase physical gold, not gold ETFs. Chinese industrial buyers grasp this reality. That's why they take physical delivery in Shanghai. Retail investors must learn this lesson rapidly or become bag holders of broken promises. As news of shortages spreads, panic accelerates. Lines will likely form outside coin shops. Delivery delays will stretch from 2 weeks to 2 months. Premiums will expand until paper prices become irrelevant. This places futures exchanges in impossible positions. If street prices reach $110, while exchange prices quote $82, any trader holding warehouse receipts will demand delivery. They'll extract metal at $82 and sell on streets for $110. This arbitrage drains exchange vaults until they reach 0. Vaults are already bleeding. Registered categories representing metal actually available for delivery have dropped to historic lows. The recent 10% move signals markets detecting barrel bottoms. It's the realization that at $80, no metal remains, so prices must reach 90. If no metal exists at 90, prices climb to 100. They continue rising until someone somewhere agrees to sell family silver. But who's selling? Are you? Doubtful. You've held through difficult periods. You understand fundamentals. You know about battery technology, debt dynamics, and geopolitical tensions. You're not surrendering insurance policies just because houses caught fire. You're gripping tighter. So you've got massive new industrial demand, panic retail buying, and legacy holder bases refusing to sell. This creates recipes for vertical melt-ups, but critical warnings remain. Don't use leverage. Banks know retail crowds arrived. They know new buyers operate emotionally and overextend. They'll attempt washouts through engineered flash crashes, potentially dropping prices $10 in 10 minutes during low liquidity periods just to trigger stop losses. If you're trading on margin, you'll get wiped out. You'll be correct about direction, but lose accounts before reaching destinations. The retail tsunami represents the final wave. Smart money moved first. Industrial money followed second. Public money arrives now. When public participation begins, volatility explodes. We'll observe days where silver moves $5, $10, perhaps $15. Ranges are expanding. Stability disappeared. We're entering mania phases. Once assets break all-time highs and enter price discovery, no maps exist. No resistance levels appear on charts because we've never been here before. We're flying into vacuums. So where does this stop? Is 84 the top? Is 100 the peak? We cannot look at dollar prices. As established, dollars are broken measuring sticks. Measuring silver in dollars resembles measuring bridge lengths with rubber bands. The rubber band stretches, making bridges appear longer. Instead, examine relative value. Look at relationships between monetary metals, gold and silver. Gold currently trades around $4,580, holding firm as the anchor for emerging financial systems. Now consider the gold to silver ratio. Throughout monetary history from Roman Empire to constitutional America, natural ratios approximated 15 to 1. For every 15 silver ounces in the earth, 1 gold ounce existed. In modern eras, that ratio exploded to 80, 90, even 100 to 1. This signaled extreme suppression, treating silver as cheap industrial byproduct, rather than scarce monetary asset. Today, with gold at $4,580 and silver at $82, ratios approximate 55 to 1. The ratio is collapsing and reverting toward means. If silver simply returned to historic monetary norms of 15 to 1 against current gold prices, where would it trade? Do the mathematics. 4,580 divided by 15 equals roughly $305 per ounce. At $82, silver isn't expensive. It's dramatically undervalued, trading at 70% discounts to monetary parity. This is the catch-up trade. Algorithms recognize this. This is why moves to $100 represent questions of when, not if. Shanghai prices already reached $91. Street prices already exceeded $100. Paper prices have no choice but following. $100 is the psychological barrier. Humans love round numbers. When silver crosses $100, it triggers global media frenzies. It'll appear on magazine covers and nightly news lead stories. That's the moment of maximum danger and maximum opportunity. If you sell silver for dollars, what are you actually doing? Trading hard, appreciating assets for soft, collapsing currency. You're jumping off lifeboats, swimming back to Titanics because Titanics have minibars. Dollars aren't destinations, dollars are victims. We're living through currency resets. When debt bubbles pop, currencies die. In every currency collapse throughout history, from Weimar Germany to Zimbabwe to Venezuela, those who sold gold and silver too early regretted it. They sold for millions of paper units, only discovering bread cost billions of paper units a month later. So when do you sell? You sell when you can trade ounces for income-producing hard assets. This is the ounces to acres strategy. Don't trade silver for paper. Trade it for land, rental properties, businesses, or energy infrastructure. Wait for manias to peak so high that real estate prices crashed relative to silver. Right now, it might require 5,000 silver ounces to purchase decent houses. In peak manias, it might require 500 ounces. That's the trade. Swap one generational wealth form for another, bypassing fiat currency entirely. But we're not there yet. We're at $82, just leaving launch pads. The week ahead will be the longest financial week of your life. Volatility will nauseate. Banks will launch counterattacks attempting to smash prices down to $75, triggering stop losses. They'll spread rumors of ceasefires or bailouts trying to calm markets. Ignore noise, watch flows. Are central banks buying bonds back? No. Are manufacturers stopping battery production? No. Are Shanghai premiums disappearing? No. Fundamentals are locked in. Bridges are burning behind us. There's no returning to $20 silver. That world vanished. We're entering eras of resource nationalism. Countries possessing silver like Mexico and Peru will start hoarding. Countries needing silver like America and China will fight for it. You, the individual investor, stand in the middle of this geopolitical brawl, holding the only thing everyone wants. Don't let them shake you loose. Hold positions. Secure vaults. Educate families. The great repricing isn't just about wealth accumulation. It's about surviving transitions from debt-based economies to resource-based economies. Paper promises died over the weekend. Price discovery began Monday morning, and the future belongs to those holding physical reality in their hands. Stay safe, stay informed, and welcome to the age of real money.